Just if we're frank at the top, analysts are broadly disappointed with the outright loss that's been reported by Diamond Bank on a quarter-on-quarter basis, where we had this positive top-line growth and that not really filtering through to the bottom line, both PBT and PAT surprisingly negative in that regard. Give us a sense of what actually played out last year, because it seems that the fourth quarter was a particularly tough period.
Alicia, nice to have you again. Back in 2010, I'm sure you recall that there's quite a number of challenges for the entire industry. But if we look at our financial results, taking it from where you left the question of quarter four, there was actually no challenge for the bank as itself. Because if you look at the performance of the bank versus that of the group, you will see that clearly the bank was on track with its projection. In fact, the profit before tax for the bank is actually about 9.5 billion, which is a healthy improvement from last year. But when you look at the group numbers, that is where the challenges began to come. And you recall that the issue of subsidiary performance has actually been a challenge across board, not just for Diamond Bank. So what had happened is that in the last quarter of 2010, we've had to take some provision for the assets that are in these subsidiary books. But you also know that most of the banks in Nigeria are now in the process of having to, tidy up their subsidiary operations going into the future.
In this tidying up process, let's take a look at your status with regards to provisioning made for NPLs, because we have the NPL ratio improving to 14.8% compared to 18.3% a year ago, and yet provisions are on the up. And it seems paradoxical because it implies that there is some kind of deterioration then in asset quality.
Yes, again, Alicia, if you look again at the details of the financials, you'll recall that at the bank level, there is actually no deterioration in value of provisioning. And the provisioning, for example, is only 17 billion for the bank as a whole. It now jumped into 23 billion when you look at the group numbers, which suggests that most of the provisioning, about 5 to 6 billion naira, was actually in respect of risk assets or capital market assets which are in the subsidiaries, actually not in that of the bank. But going forward, we want to begin to see what the ratio will look like. Our cost of risk in the next financial year, we're already expecting it to drop even below what we have today. If you look at what we had the year before, it was about 10.2%, which has improved significantly to about 6.5% in the last financial year. And we believe that going into the future, we'll be able to actually do something in the region of sub 5%.
Quite impressive is the kind of retail deposit growth that we're seeing filtered through. It's now accounting for 50% of total deposits. Your customer accounts have also grown to 1.7 million from 1.3 million a year ago. But if we're taking a look at total loans to customers, that has pulled back 5%. Still, that loan-to-deposit ratio is sitting at 83.7%. How are you managing risk when it comes to that loan component of the business and assessing asset quality that you're actually taking on here? Or is it just simply a matter of taking on less?
Okay, the good thing about our strategy going forward is that we are going more significantly into the retail space. And when you go into the retail space, the issue of concentration risk is actually significantly reduced. So what we now have is about 50% of our deposits coming from the retail sector. And therefore, when there are movements in the economy, these are not very responsive in terms of elasticity to changes. And we expect that this will give us a lot more quality. And if you look at the overall portfolio of deposits, again, we have current account and savings account, which are supposed to be the target market, now accounting for as much as 75%, up from 50% in the previous period. Now, on the risk asset side, the good thing about having the retail segment in growth is that the spread of the overall portfolio is now over a wide and much wider number of clients, unlike in the past where you have too much concentration. And the growth in that area is expected to continue into the future. In terms of default risk, we've seen very, very little default in the area of retail business.
How much of a reduction in loan loss provisions should the market be anticipating for the 2011 financial year?
We expect for the bank itself to be somewhere around half. So we don't think there will be much. However, from the subsidiary business, you would expect that when we finally get to unwind that investment in that area, then our consolidation of financials going into the future will no longer have the non-bank financials, and therefore that should begin to ameliorate. So we don't think beyond Q2 we should have anything to do with further costs in terms of subsidiary divestments.
So where the bank did not sell NPLs to AMCON in round 1, with round 2 of AMCON's purchase coming up, should we be expecting to see a change in position or not?
Well, I think if you recall, only banks that were in the CBN rescued situation had all of their NPL available for disposal or sale to AMCON. For the banks who are not in that category, only the capital market related ones, the ones we call the margin loans here, are the ones that were disposed of. And in that respect, we also did a little bit of it. We did about 11 billion naira worth of asset disposal to AMCON in the phase 1. In the phase 2, where it had now been opened up to all other classes of risk assets, we're also beginning to put together a request, and I think we have somewhere around 20 billion, which we are going to dispose in this. By this estimation, we then are likely to see a reduction in the non-performing loan portfolio, dropping from 15%, which is what you have in December 2010, to about 8 or thereabout after this disposal. But our target actually is to work towards sub 5% by the end of the 2010-2011 financial year.
We've obviously had weak earnings ruling out a divvy payout this time round. Very quickly, moving forward, should we be expecting to see some kind of divvy through the course of this year?
No, in terms of earnings, the earning fundamentals of the bank is very strong and on the increase. If you check at the bank level, you actually see that it was a very strong potential. Q1 results will be out in another few weeks, and we're very positive that you're going to see some improvement in that regard.